Welcome to the Fresh Start for Life podcast, the show that will help you get out of debt and start living the financial life of your dreams. Now, here's your host, Don Golden.
Hi, everybody. Thanks for tuning into the show today. It took me 20 years to pay off my student loans, and my student loan debt definitely, it acted kind of an anchor on my personal finances for this 20-year period of time. It was something that kind of held me back financially a little bit. I have three kids. One is 17, one is 15, and one is 8. And the 17-year-old's a junior in high school, starting to think about college. And I do not want my children to have to be saddled with the unbelievable student loan debt that I had. So I've been doing a little research on the subject. I came across some statistics that were pretty alarming. I want to share them with you right now. Currently in this country, 45 million people owe money on student loans. And those 45 million people owe $1.56 trillion. That's trillion dollars. That is an unbelievable amount of money, folks. That is actually more than credit card and car loans put together. So just think about that for a minute. $1.56 trillion. Crazy amount of money. And here's the worst part of all. 11.5% of student loans are currently 90 days delinquent or in default. That's horrible. And that doesn't even account for the millions of people that are probably 30 and 60 days delinquent on their loans as well. For these millions and millions of people who are falling behind in their student loans and struggling with student loan debt, they're going to really have a hard time ever living the financial lives of their dreams until they can get this student loan debt under control. So I just knew we had to do a show on this subject. So today we are going to talk to Tampa-based student loan attorney Christie Arkovich. Christie specializes in representing borrowers who are struggling with student loans, and she's going to give us a lot of great information on how to deal with these loans and hopefully keep them out of default. So let's jump right to that interview. All right, we would like to welcome to the show student loan attorney Christie Arkovich. Welcome, Christie.
Thank you, Don. I think this is great that you're doing this.
So, Christie, I talked about this a little bit in the show open, and I want to bring it up with you. I mean, I saw some alarming statistics. I was on studentloanhero.com. Hopefully that's a reputable site. It seemed like they were taking their information from government websites and stuff. But according to that website, there's $1.56 trillion in student loan debt right now. And that's $520 billion more than credit card debt. And there's 45 million borrowers that owe money on student loans. Those numbers are crazy.
Yeah, they are crazy. Now, vehicle debt and credit card debt combined are less than student loan debt. So it is really a crushing problem out there for a lot of Americans.
What impact? That definitely has an impact on our economy, correct? With that level of student loan debt?
Oh, sure.
What kind of impact?
I mean, well, most of the clients who come to see us, they're folks who have tried to repay their debt for 10 or 20 years, and they realize that they're not making any headway, and it's causing them problems in starting families and getting married. Some of them are afraid because they don't want to drag their spouse into their debt problems. They're not buying houses. Many times they're not going to school, to get advanced degrees to move up in their career. And so it is a big problem.
That has an effect on everything. I mean, it's probably slowing down the economy. It could be, at least.
Yeah, the argument is that millennials, they're not buying homes because they see what their parents have gone through. And that might have been the foreclosure crisis recently, job losses, but a big part of it is student loans because we have people with student loans running the entire gamut all the way up until retirement age. I've got 70-year-olds with student loans that are facing a Social Security offset. So it's not just a problem for graduates, and it has a draw on the economy. Yes.
Wow. I want to take just a step back. And, some of our listeners may not know a lot about student loans. So I'd like to just get them a little bit educated on the different types of student loans there are. So could we start there? And could you explain what different student loans are available to borrowers?
When someone first goes to school, they're usually looking at federal student loans. Nowadays, they're looking at direct loans because the government eliminated the older federal family education loans, the FFELP loans, and they replaced them with direct. So you're looking at direct loans. Before 2010, 80% of the loans were actually originated by private lenders using government subsidized money, and those were the FFEL loans. And the difference is important because there's certain loan repayment programs that are only eligible for loan types. Public service loan forgiveness, for instance, FFEL loans aren't eligible for that. And that's one of our biggest problems out there is people don't realize what they have, so they don't know what they qualify for. And sometimes the servicers really don't have the answers for them for various reasons. But you've got federal loans. That's a big component. You also have private loans. Private loans are where folks can get into trouble. The last private loan client that came in to see me yesterday afternoon, their interest rates were 15%. If you've got, 30, 40, 50, 60, $70,000 of debt at 15% interest, whatever payment you're making, you're usually not making a dent in it. And it will be a lifetime loan for something that may have only been an AA degree. So you really have to watch taking out private debt. I think federal debt is a far better avenue to pursue. Now, scholarships, grants, all of that is great too, if the student would qualify for it.
When does a person need private loans? Is there a time when you don't really have much choice but to borrow private money?
Well, yes, there's eligibility standards for federal loans. You do run out of that. For instance, if you're switching majors or going to an expensive school or something like that, they'll look to the parents, maybe for a parent plus loan or grandparent. They'll sign their own federal loan that they're responsible for if the student has exceeded their eligibility. And then private loans. There's also some schools that aren't eligible for federal funding. Caribbean, for instance, has approximately 50 medical schools. I couldn't believe it when I first heard that. I thought that was an insane number. But in any event, there's only about a handful that are eligible for federal aid. And so the rest of them have to either be paid in cash by family funds or they get private loans. That's kind of where private loans come from.
When you talk about eligibility, other than the Caribbean medical schools and stuff like that, what would make somebody not eligible if they're going to, say, Florida State University for federal loans?
I don't know if I can really answer that question because it's not something we deal with a lot. I imagine it's someone maybe that didn't have a GED or didn't have a high school diploma, maybe something like that.
Is there a cap, though? Isn't there a cap on how much you can borrow?
There is, but I don't know what the caps are.
Okay,
and they do vary based on degrees and areas of study and things.
Right. So at some point, you may exceed the cap on the federal loan, which would make you ineligible for other federal loans. And
exactly.
Then you'd have to resort to the private loans.
Exactly.
Okay, gotcha. Yeah, that's kind of what I thought.
There's a few folks that go directly to private loans, but that's uncommon. I don't know if it's because they didn't want to fill out the FAFSA information or maybe, I don't know, but it's very, very few. Most people use federal first, and I would strongly encourage that people do utilize their federal. That may change, though, because the recent budget that I just was looking over last night a little bit that was presented by President Trump proposed that the federal Department of Ed kind of downsize, basically, and walk away from some of the student loan, not programs necessarily, but some of the aid. So that may change in the future.
Interesting. Wow. That's scary. As a parent that has a 17-year-old junior in high school, looking to go to college soon, that's a little bit of a scary thing. What other differences are there between the federal and the private loans? You mentioned the interest rate and things, but what other differences are there?
Well, with federal loans, they come with a number of programs. For many folks, the income-driven programs are excellent to reduce a payment. They also allow for debt forgiveness at the end of the payment program. That's a huge thing. Disability, there's a total and permanent disability application available for federal loans. There is a borrower defense for fraud, basically, for those folks that might have went to for-profit schools like Corinthian or Everest or even ITT to try to discharge their loan. So there's a lot of different federal programs, designed to either sometimes partially eliminate or discharge the debt or allow for more reasonable payments and then ultimately forgiveness. A lot of folks don't realize what the programs are. They think they qualify when they don't. There's 8 different income-driven plans. It might be in the wrong one. So there's a lot of problems there, but the programs exist and they are good programs. With private loans, there are no programs.
Right.
It's basically whatever the private lender tells them, here's your payment. And it's usually something that's very unreasonable, doesn't take into account what the federal loan payment is, offers, they do have forbearance and deferment for periods of time, but once that's exceeded, usually the payment is very large. They also have co-borrowers. That's another difference with private loans, higher interest rates. So the co-borrowers provide a bit of a limitation because sometimes our students, former students, in order to try to negotiate a settlement or something with the private student loan, sometimes having a co-borrower throws an extra element of problems or surprise there. There's quite a bit of differences between them. And when clients come to see us, sometimes they don't actually know what they have.
Right.
And so one of the easiest ways to find that out is there's a National Student Loan Database Report in SLDS. And you can go online there and you can print a 1-page summary that will show all of your federal loans. It's a federal database, regardless of who has them, whether it's with a debt collector or whether you have multiple servicers or guarantors or whatnot. There's no private loan database, though. So the only way to identify if years have gone by what someone has in private loans is check out the credit report, They may be getting collection calls or letters or something. And one of the other key differences is that private loans will settle, federal loans won't.
Right.
And private loans have statute of limitations and federal loans don't. So there's quite a bit of differences between them.
Right. That what you're talking about there is when they go into default, right? That was the next subject I wanted to get into, actually. What is delinquent and default? What does that mean? And what are the borrower's options when they're either delinquent or in default?
For federal loans, that's usually where that terminology comes into account. A delinquency is whenever you're behind up to 270 days, which is 9 months. Once you're that far behind, 9 months, they default the loan and things change. At that point, they add 25% collection costs. So no one should purposely default on a federal loan. It doesn't help. They also become subject to 15% garnishment administratively. There's no need to go to court and get a judgment first. They just send a letter. And half the time, the letter goes to an old address. So the client doesn't really know that garnishment is going to be hitting them. Social Security offsets, tax refunds, seizures, all that can take place for federal loans once they default. They typically don't file a lawsuit as long as they're collecting something. If they're not getting anything, eventually the federal government will refer it to the Department of Justice to file a complaint in a lawsuit. We haven't had that many cases because usually the government can get something through those other means. It usually takes years for them to want to actually sue, but they can if they want to. And there's no statute of limitations. So for private loans, it's a little different. Yes, you have a delinquency period. Technically, legally, a private loan is in default the first day a payment's not made that should have been made. But most of the private servicers will consider a period of time of approximately 6 months that the loan is in default. So we're looking at settling private student loan debt after it's 6 months in arrears or delinquent so that it has defaulted.
And both private and federal loans, do they report on the credit report?
Yes, they don't have to. They're not required to, but usually they will. Okay. And sometimes it'll come off.
Both federal and private loans do, right?
Correct.
Okay, so if a student's in default on their student loan, or actually a borrower, because they may or may not be in school anymore now, but a borrower defaults on their student loan, that's definitely going to have an impact on their credit score, more than likely.
Yes, absolutely. And one of the bad things is that most people don't have one student loan. They might have 4 to 15 or so. And so it may have, 10 different hits per month based on the number of accounts. Yeah, it can be a huge hit. For federal loans, if there is a default, it can be rehabilitated. It's called a rehab. And then the default is removed. The late pays stay on there, but they're eventually replaced with current payments. But the default can be removed. And then with private ones, it all depends on the negotiations during debt settlement as to whether or not the trade line can be eliminated or it may be disputed and an FCRA claim may exist later if an older creditor doesn't reinvestigate and remove the account once it's been settled and paid. So there's issues there.
You mentioned about the default, what some of the ramifications of the default could be, but what can a borrower do if they fall behind? Because the big thing that you said, that's scary. What was it? Was it 25%? If you default is the add-on? Is that like the penalty type of thing? So that is.
And there's actually, defaults are really problematic because you can default more than once. So you can have 25% more than once. And unfortunately that happens because if someone on their own rehabs, the loan is ultimately sold to a new party once the rehab is done after 9 months. And they don't know who the new party is. So they might think, well, this is a scam because there are scams out there. And they may not send payments to that new company having never heard of them and accidentally default again. And so now they have another 25%. So it is an issue. In Florida, we have a particularly bad problem where the law allows for healthcare workers' licenses to be suspended if their federal loans are in default. Exactly. So one of our clients was featured in a news article, I think it was by ABC Action News, and she was about to lose her license and was getting it reinstated. Also, there's a nurses group just this week that is marching on Tallahassee to try to get some recognition of that problem because it's an issue. I mean, taking someone's pay, 15%, that still allows them to live. But if you're taking their entire pay by suspending their license so that they are no longer working, getting them fired is not helping them pay their student loan. It's not really the best means to the end, which is payment of that debt. And there's 2 senators, Senator Warren and Senator Rubio, that have a bipartisan bill right now to try to eliminate that license suspension. And some states have taken it further. I understand Iowa has, and I don't know if this is correct, this is more word of mouth, but I understand they have it where driver's licenses and hunter's licenses can be suspended. And so it varies state to state what's going on, but Florida is the only one that does the healthcare licenses. But to answer your question about trying to get a loan out of default, that is one of the big things that we do. And basically, when we cure a default, there's two different ways of doing that. It's called consolidation or rehabilitation. And there's differences between them, different reasons why we might choose one versus the other. But either one results in the loan being then current, and then the client is eligible for any of the income-driven plans or non-income-driven plans. There's no longer a credit problem. There's no longer any risk of garnishment and things.
And the other big issue, I think, with a loan being in default is you're not eligible for any more federal student loans at that point while the loan's in default. Is that right?
That's right.
Okay.
You're absolutely correct.
By getting it out of default, you would become eligible again if you needed to go back to school or, whatever.
Right.
You said something that I honestly did not know, and that's about the professional license being suspended. I did not know that that was a remedy, and that's pretty scary. Obviously, attorneys generally have student loan debt, so it's scary to think that somebody that may work for me or, somebody that could work for me in the future may lose their license if they fall behind on their student loan. That's terrible.
Well, it actually is limited to just healthcare professionals right now.
Okay.
But this would be nurses, LPNs, CNAs. And, with Florida, we have a huge marketplace for that. And I understand that we have, I think, a nurses shortage. So The timing is particularly bad that they're doing this. Because we need those nurses.
That's crazy to me. Why would they single out healthcare professionals? It makes no sense.
I have no idea.
Yeah,
I have no idea.
It seems arbitrary.
And it's not just those with HEAL loans either. With health loans, it's basically any federal loan.
Wow, interesting. Now, because the hammer is so heavy when you go into default, there are options for people to avoid that, correct? If you could just talk a little bit about what your options are while you're just delinquent, so that you could avoid default, that would be, I think, really helpful for our listeners.
There's this thing called income-driven plans. And so most of the time, when a person runs into a hardship financially and they can't pay their student loan, the first thing that the servicer will recommend is let's go into forbearance.
Right.
And it's very easy to get, usually by a phone call only. The problem with forbearance is that it can last for many years. There's no payments. The capitalization of interest causes the loan balance to balloon. You can have 2 or 3 times the balance you started with in 5-10 years or so. CFPB, Consumer Financial Protection Bureau, they actually sued Navient, which is the biggest servicer, a spinoff of Sallie Mae, and said that, hey, they were leading people into forbearance. And really, when you have what I call a chronic underemployment, which means you're not making enough money to maintain a standard of living plus make your student loan payment, then you need to be on an income-driven plan, not just forbearance. So the first thing I would tell people is think of forbearance as a Band-Aid, not as a permanent fix. Mm-hmm. And instead, look at the income-driven options. There's 8 different plans. Some of them take a spouse's income into play in calculating what the payment is. Some don't. Some are available for Parent Plus loans only. Only those with Parent Plus loans would choose. It's called ICR. It's not as good of a repayment plan as the other ones, but with Parent Plus loans, it's the only one available. But usually you're looking at situations where they can use IBR or repay or pay or ICR. ISR is one that doesn't allow for debt forgiveness. So I would never choose that. That's the oldest one of the group. But essentially there's 8 different ones. They come under this umbrella as income-driven plans. And the whole purpose of them is to have a payment reduced from what might be $1,000 or so, reduced to what is 10 or 15% usually of their disposable income. It's usually an affordable payment. And what they do is they renew each year. It's called the certification process. I encourage folks to do it a few weeks early, make sure it has enough time to process. And then at the end of either 20 or 25 years, if there is a balance remaining, if their income has been so low that they've never really had a chance to make substantial payments on their student loans, any balance remaining, including accrued interest, would be forgiven. And in public service, that time period of 20, 25 years is actually shrunk to 10. So 10 years, that can go by very, very fast.
What qualifies you for the public service forgiveness?
Well, first of all, you have to have the right loan type, and it has to be a direct loan. We see huge problems with that because a lot of folks don't know there's differences between those loan types. And unfortunately, the servicers, we found that many servicers are not accurate in representing whether someone is correctly in the public service program. And it turns out that they think they are and they're not.
Right.
And so we've brought a couple class actions against Navient and Great Lakes alleging misrepresentations on behalf of our public service workers. But so first of all, they have to have direct loans. They also have to be in an income-driven plan. A 10-year standard payment would work too, but if you were in that for the whole 10 years, your loan would be paid off. So usually what we'll see is a few years of public service and maybe a couple years of 10-year standard when they're making more money. They also have to be working full-time for a qualifying employer. It's usually a 501c3 with the primary purpose that fits a list that the Department of Ed has, usually healthcare, education, things like that, police. It has to be full-time, can't be volunteer work, 30 hours or more. And then they make 120 timely payments. And at the end of it, they go ahead and apply for the discharge. So one of the important things is that people, if they think that they may be eligible for public service, first of all, they need to make sure they have direct loans, they're on an income-driven plan, and then there is a public service loan certification form that they can fill out every year. It's existed since 2012. And they, FedLoan, which is the servicer for public service, they'll check it over and make sure that their last 12 months qualified. And if they do that each year, they'll have a running total of how many months they have accrued. They'll know they're on track for real without just trusting some $10 an hour employee to maybe tell them the truth. And so that form is very, very helpful.
That's something that I was not aware of until recently, was this certification. There's been some litigation over that. Is that correct? With the public, I don't know if it's in litigation yet, but I saw some alarming statistics about the number of people that are eligible and that have applied and the rate that they're getting approved.
Yeah. I know all about those statistics.
Yeah.
Sure. In September, they came out, the Inspector General's report came out and said that I believe only, it was either 58 or 95. I've seen two different reports. Borrowers had qualified out of potentially hundreds of thousands that had applied. So there's been a number of news articles about that and things. As for litigation, we have our two pending cases. We may have additional shortly. There was one case that was filed by a bunch of attorneys, actually, the ABA. They worked public service for the ABA. They actually did public service work. It was very clear. But the ABA does other things too. And I don't think they're a 501c3. I think they're a different section. But anyway, their argument is that the Department of Ed had changed the qualifications that were required for public service midway, and that they first qualified and then they didn't qualify. And so what is really nice was about a week ago, there was an opinion that came out that said that they were correct, that the Department of Ed cannot arbitrarily and capriciously change things like that causes their denial for public service. I haven't read the opinion, but I read a blurb about it and have it on my list of things to read. But that's a very important judicial opinion because it may limit the Department of Ed's scope on making a change halfway through the program. The program itself has not been very well run because it came out in October 2007. It wasn't until 5 years that the certification form even existed. And I'm seeing even this year, clients not being informed that there is that form or that they need to even have direct loans or be in an income-driven plan. We commonly will see someone they're in a lower payment, but they're in graduated or extended, and that doesn't qualify. And they have no clue. They think they're public service. And so a lot of folks are being misled. And I think it's causing a national tragedy for our public service workers because they're the most deserving of this aid. And they're simply not getting it.
Well, the whole idea behind it, I think, was to encourage people to go into this kind of work, and
it was.
Yeah. I mean, because we need nurses and we need teachers and we need people to do these jobs that aren't always the highest paying jobs. So having the student loan forgiveness program is attractive.
Yes, and that was exactly why Congress passed it. Initially, our whole federal loan system was passed because I caught this from the Netflix show, Patriot Act. They had done about 2 weeks ago a segment on student loans. It was fascinating. We also were focused on there a couple times, so kind of like that. But during the report, they said, the whole federal loan system exists because Russia got ahead of us in I think it was called the Sputnik program. And so we all of a sudden realized, we realized we need scientists and engineers. And so they started the federal loan system. Then public service, they realized that people didn't, they couldn't really afford to go to education or get their education, get a master's and bachelor's degree, and then work public service. So that was exactly why the program was created. Because some of our biggest clientele that are most negatively affected are frankly teachers, because many teachers have to have a master's degree. That's very expensive to get that. Mm-hmm. And their pay will virtually never pay for that without public service coming into the picture.
You had mentioned a lawsuit, I think that you were involved with Navient. Is that something you can talk about?
Sure. We're in the initial stages.
Okay.
We're in class certification now. We were able to prevail on a motion to dismiss, but that's, as you know, one of the earlier motions. So it may take a couple, 3 years still. Well, the issue is whether or not representatives of the servicers are allowed to make misrepresentations concerning the borrower's options.
Okay.
And we believe that if a servicer makes an affirmative representation, that they should be held accountable for that. You know, they're telling people one thing and that's not true, and these folks are relying upon that.
You mentioned servicer, and I don't think we've talked about servicer yet during this interview. So if you could just explain what a servicer is, I think that would be helpful.
They're basically the other side. They represent the creditor, and that's one of the important distinctions that I've always tried to make. A servicer of a loan, which is basically the creditor's representative, the one that they're speaking with, they don't represent the borrower. And in litigation, they'll come out and say that. They say, no, we represent the creditor. We're not required to give all options to the borrower. They have to figure that out on their own, basically. But that's not something that the borrower comes to believe on their own. If you were to look at the websites and things of these various servicers in the Department of Ed, it looks like the servicer is there for them, that they're there to protect the borrower's rights, to give them all their options. And in reality, that's not true. They are the other side. There's no duty in their mind to properly represent the borrower. It's not their client.
So basically, the government is the lender, and the servicer is kind of the collector in a way, right? They collect the money. Okay, got it.
They're the middleman. They collect the money and
I've done a little bit of student loan work, not a lot. I refer it all to you now, but basically,
thank you.
No problem. I'm glad to do it. You definitely know your stuff here. My understanding is there's a Department of Education rule regarding that, though, isn't there, on how servicers are supposed to interact with borrowers and what their duties are to them, and that they have to provide them with the information about their repayment options?
Absolutely. They all have servicing agreements with their servicers. But the interesting thing is, and there was another Inspector General's report that came out in February, and it was a very damaging report. It essentially said that 61%, and that's a huge number, 61% of inquiries, whatever they were, you know, whether it was phone calls or written correspondence between a servicer and a borrower, were flat out wrong, where the servicer did not give the appropriate advice. They missed options. They explained things incorrectly, whatever it was. Could have been dealing with income-driven plans, maybe with forbearance, maybe capitalization, maybe public service. And, you know, I have this thing where if a client comes to me and I'm hired and I don't follow the law 61% of the time, I'm pretty sure the Florida bar would have something to say about that.
Absolutely.
And I wouldn't have my license. And I wouldn't have my license for that much longer. Where here, the report was basically saying the Department of Ed doesn't seem to care. You know, they don't have policies and procedures in place that penalize the servicers that don't do a good job. And that's a problem. And they were trying to instill that within the Department of Ed so that they can oversee and manage their, you know, they've got like a dozen or more servicers out there working for them and then many more debt collectors. But nobody's really, you know, looking over their shoulder to make sure they're doing it correctly is what the Inspector General was complaining about.
Wow. Oh boy, there's so much going on here. This is definitely a problem that is going to linger, I think, for many years to come. I think you did a lot of foreclosure defense and that kind of work during the housing crisis. Is that correct? Did you do some of that work?
Yes, I did. Yeah.
I was just going to ask you, staying on the student loan topic, do you see this as being that kind of potential crisis for our country financially down the road, or no?
Well, I don't know if it will ever equal the magnitude of the foreclosure crisis. I don't know. Do you remember how many homes were in foreclosure at the height of it here in Florida?
I do not.
Yeah, I don't remember exactly either. But what I have found is that 1 out of 3 families usually have student loans. And like I mentioned, it can be a young borrower, you know, someone just out of college. It can be someone middle-aged, you know, with children and everything, trying to maintain a family, or it can be someone retired. So if you have a situation where they have an unpayable bill, 1 out of 3 families, then I think it could reach the magnitude of what our foreclosure crisis did. But people have been really kind of just putting it on the back burner. Remember I mentioned forbearance? So eventually the bill is going to come due. And it's starting to come due for many people now where they're running out of forbearance options. And they realize that they've got to start making payments on this. But what we do is we can try to, like I mentioned, take people out of default, make sure they don't go into default in the first place, put them on these plans that allow for an affordable payment. And with our private loans, we can usually negotiate an affordable, sustainable payment with an end in sight. That's one of our goals, is we want an end in sight. Because most everybody that reaches us, you know, they have a lifetime student loan is how they think of it. So I do think that overall with our economy, unless folks look at how, what the big picture is, how they can get rid of the student loan, it's always going to be a drag on their own personal family finances for the remainder of their life. And then if it's affecting 1 out of 3 people, that would affect our economy as a whole, sure.
We're running out of time quickly here. Can you just tell our listeners how, to me, it seems like really it shouldn't be necessary, but it seems to me you need a lawyer to help you navigate through this complexity of student loans. And that is your specialty. So could you tell our listeners how people could
Sure.
reach out to you?
We have a few different things. One is we have a survival center of student loan resources available on our website, and that's located at ChristieArkovich.com. And so that's spelled CHRISTIE, and the last name is ARKOVICH.com. We also have a free ebook that I've written called Take Your Life Back from Your Student Loans. That's very popular. In addition, we do offer a consultation. We have had to start charging for that. There's so much demand that we can't do them for free any longer, but it's only $175. And we offer a very nice guarantee. And the guarantee is this: if the person consulting with us, if they hire us, we waive the fee. And if it turns out that we can tell them what they need to do and how to do it during the half an hour, then they don't need to hire an attorney, and they've saved themselves the additional cost of doing that. And then 3, if it turns out that we can't help them, and they're doing everything they can, and it only takes us a few minutes to find that out, then we will refund the fee or not even charge it. And that is good for a client to just have a double check. They make sure that they're doing everything they can to get that peace of mind. And that's a huge problem because you've got all these websites out there with a lot of information, the Department of Ed. It's confusing, and then the servicers don't represent the borrowers. So seeing a student loan attorney gives someone an assurance that they are really doing everything that they can do, or here's what they need to do instead.
Absolutely. Well, Christie, this was great. You definitely gave our listeners a lot of very good information, and I encourage everyone to give Christie a call if they have any questions about student loan debt. Thanks, Christie. I really appreciate it.
Thank you, Don. Let me mention my phone number.
Sorry. Absolutely.
Is 813-258-2808, and we'd be happy to help anyone. And I appreciate the time, Don. I think that your new podcast would be a really good help for people that want to restart their lives after bankruptcy and get their financial footing back in order. So I think it sounds great.
I appreciate that. Thank you so much. And I'll talk to you again soon. Bye-bye. Thank you, Christie. Wow, that was a lot of information. Hopefully you got a lot out of that interview. I know I learned a lot. Right now, I just want to go over the 3 big things that I'm taking away from this interview. Like I always say, you probably have some other takeaways. I hope you do. But I want to share with you my 3 big takeaways. The first one is, and this, I'm not sure we really talked about this in the interview, but this is my own personal opinion. If you're looking to go to school and you're looking to borrow some money, take out some student loans, only borrow what you need. The schools make it so easy, and the financial aid system makes it so easy for you to borrow a lot of money, but try to limit it to only what you absolutely need, and definitely try to stay within the federal loan limits. That way, if you could avoid the private loans, that would be preferable, because as we did talk about, there are different repayment options for federal and private loans, and the federal repayment options are so much more flexible. So try to avoid private loans if at all possible, and in doing so, only borrow what you need, absolutely need. That way you limit the amount of money that you'll be paying back over the term of the loan as well. Number 2, don't default. That 25% penalty is an absolute killer to you financially. If you go into default, they're going to add 25% to the principal, and then you're going to start paying interest on not just the original principal, but the principal plus the 25% penalty. So do everything you can to try to stay out of default. Best way to stay out of default is hopefully an income-based repayment plan if you can afford to make payments, but you just can't afford the full amount of the payment. If you can't make any payment at all, then definitely seek a deferment or forbearance. But just remember, those are only temporary solutions. Eventually, you're going to need to start making payments on those loans. But at all costs, try to stay out of default because the penalty is just too severe and it will really kill you financially. And the third thing is this stuff is really complicated. So if you have any issues, you're confused, you feel like you need some help, I highly recommend you speak to a student loan lawyer. It's worth the money if you do have to pay a consultation fee to speak to a student loan lawyer if they can help you stay out of default and avoid having to pay a 25% penalty. So if you're in the Tampa area, definitely you can give Christie a call. Or if you're outside of the Tampa area and you're looking for a student loan lawyer, I would recommend a website. It's thestudentloanlawyer.com, thestudentloanlawyer.com. We'll put a link to that in the show notes. And there's a full list of student loan lawyers on that site that are available to you all around the country. So that was a lot. I was hoping today we would get to talk a little bit about dischargeability and bankruptcy of student loan debt, but the show was just going to be too long, so we had to not get into that subject today. But we will definitely do a whole episode on discharging student loan debt and bankruptcy. But that'll do it for this week's episode. If you guys are enjoying the show, hopefully you're getting a lot out of this show. I'm going to ask you once again to go ahead and subscribe to the show. And if you really want to even take it to the next level, if you could leave us a review, I'd really be interested to hear what you have to say about the show. Let us know whether we're providing some value to you or not. Hopefully we are. And I just want to thank you for listening. We will talk to you in the next episode.